Welcome, Bryn and Rick.
Morning, how are you? How is everyone? Just got to check. Yep. Again, good morning to everyone, and welcome to our tax minimisation webinar. As we said in what we sent out, we said it's not too late. There's still a few things you can do. There are a couple that you may need to do in a hurry, but a lot of the others you can still apply. So I just want to introduce Bryn Robinson, my business partner as well. Everyone knows Bryn.
Good morning, everyone.
So we'll be sharing it between ourselves as we go through the agenda. So the agenda today, we're going to have a look at what is assessable income. We're going to talk about cash versus accrual, because it's another area that not everyone's certain about how they should treat their business or the income from the business. Very briefly, I'm going to talk about personal services income, because I think it's an area that's totally misunderstood. We're going to talk about income, what should be included, deductions, a couple of other things, and then we'll go to questions. So we'll get started, and it'll be a quick one. So assessable income, actually I'll hand over to you, Bryn, you can talk about that.
Okay, so if you're carrying on a business, most income you receive is obviously assessable for income tax. There are, however, some things COVID related that are not currently assessable for income tax, so they're add-backs for your tax return. And your accounting method may also affect which amounts must be included in each different income year. So depending on what method you're using will determine which financial year that income will be assessable for income tax. So cash versus accrual, it's important to know how you're reporting for income tax purposes. Sometimes you may or may not realise that the profit on your tax return or your taxable income on your tax return may be different to the profit on your financial statements. And the most common reason for this is the add-backs in the tax return. So if you're reporting on a cash basis, you need to be aware of that, because you can't simply run a profit and loss from your zero file or your MYOB file, because that will be recorded on an accruals basis. And if you're reporting on a cash basis, you may plan for the wrong amount of income tax or the wrong amount of profit for that year. So if you're accounting on a cash basis, it's basically when you receive the income, so not the date that you issue the invoice to your customer, it's the date they pay you that you declare that as income. And then similarly for expenses, it's not the date that you receive the invoice from your supplier, it's the date you actually pay them. So that's how you determine your cash profit. On an accruals basis, which generally is for larger businesses, your assessable income is calculated on the date that you issue your invoice, and similarly the date you receive the invoice. The day you make the payment or receive the payment is not really relevant on an accrual basis accounting. So in terms of using the cash method, did you want to talk about this?
Oh, okay.
So basically where the income results primarily from the services that are rendered or the work performed by the taxpayer personally, then that's assessable on a cash basis. So for example, a hairdresser, a sole trader hairdresser, or someone who's doing a service like that can pay tax on a cash basis, so when they receive the money. The following factors to a significant degree would indicate that your income should be assessed on an accruals basis and not on a cash basis. That's if you're in the business of selling trading stock, or if you're relying heavily on staff, so not your personal services, but the services of other people, or heavily relying on equipment to produce that income, then generally you'll be reporting on an accruals basis. And where the distinction is not clear, consistency is always the key. So you need to adopt the same method year in, year out, unless your circumstances change significantly, which is where tax planning comes into play, and we can discuss how that will impact that year, and you can make your changes accordingly.
Yeah, look, I think that's an important point to make too, Bryn, because you may start off as a sole trader or even a partnership and you don't have any employees, but further down the track the business grows and then you've got employees, you might even buy equipment or whatever. So that's going to change how you should be determining your income, whether it's on a cash basis or whatever. The other thing to remember too, it doesn't matter whether you're a sole trader, a partnership, trust or a company, the same cash basis and accrual basis rules apply. So at the end of the year, it isn't really the factor, it's how the income is earned. So just remember that. And one other thing too, you can actually run, I know in Xero, I think you can do it in MYOB too, you can actually, most people just run it and it comes out in accrual because that's what the default is, but you can actually run a cash profit loss.
I think what's really important is to actually know the answer to that question. Are you paying your tax on a cash or accruals basis, and speak to your tax advisor about that so that you are running the right reports and looking at the right figures.
Yeah, correct. Okay. And look, it is a bit of a timing difference. Some people think, oh, it's great to run on cash all the time, and that could very well be true, but even if you're running on accrual, it is just a timing difference, really. Eventually, you end up in the same position.
Yeah.
Okay, as I said, I just want to briefly talk about personal services income. I know it doesn't apply to everyone, but it's really a misunderstood area of tax. So personal services income is income that is mainly rewarded for an individual's personal efforts or skills. So PSI applies whether you are operating as an individual, partnership, trust, or a company. Income is classified as PSI when more than 50% of the income you receive is a reward for your personal efforts and skills rather than being generated by the use of an asset, sale of goods only, or a business structure. So some people think, oh, well, if I'm not a sole trader and I'm a company, PSI rules don't apply to me, or simply if they're in a partnership or trust. That's not correct. We have a lot of new clients come here and they've been claiming a lot of deductions that really they fall under PSI. I'll just quickly go through the rules with PSI. So there's 4 tests. So the first one is, have you received PSI? So you may need to talk to your advisor about that, but if it's generated by you personally, then yes, you're going to tick that box. So it's personal services income. But there are a few other tests to apply. So you've got the results test. So where the result test comes in, you look at probably 3 different things. If you're getting paid on an hourly rate, I can tell you now that you're going to fall under PSI because really you're no different to an employee. So you're not going to pass the results test. Results test is where you're getting paid on a result. So say, for instance, if you're a carpenter and you get paid to put up the frame as opposed to an hourly rate, you get paid on a frame basis, then you would pass the results test. And similarly, other things where you get paid for an end result. A third test is the 80% rule. So if 80% of your income is coming from one source, then you're going to fail the PSI on that particular basis. And a lot of people are in that boat. So they may think, oh, well, I can pass maybe on some other areas, but if all your income's coming from one place and that person really determines how you achieve that income, and you don't have much say in how you get paid or how you work, then you're going to fail the 80% rule. The other one is, if you've got business premises, that would be a tick to say that you're not PSI. There's a couple of other little things. So as I said, I don't want to spend a lot of time on it, but if you've got any doubts about it, it is an area that the tax office do look at, and you should seek advice on that.
Yeah, clarify that. Okay, so this is, I guess, where we start talking about the actual tax planning for the year end, which is what we're very heavily doing with our clients at the moment. And basically, we can help you minimise your exposure to income tax. And we just need to go through, we've got a sort of a strategy that we go through for all of our clients who require the income tax planning. So obviously we start off with income, and similarly to what I was saying before, if you run a P&L from your Xero file, whether you run it on a cash or an accruals basis, you need to be aware of income that's not assessable because it will be sitting in your P&L as income, but it's an add back on your tax return. And some examples of that, mostly COVID related, are the cash flow boost, the job saver, and the COVID-19 grants. However, be aware that JobKeeper is assessable, so that doesn't get added back, and you do have to pay tax on any JobKeeper. So that's the process that we go through when determining what income we need to declare for our clients. The second thing that we always ask our clients to do, especially if you're reporting on an accruals basis, is to assess your debtors. Any debtors that are sitting, outside your payment terms, are you actually going to receive that income, or is now the time to look at writing some of them off? Writing them off before the end of the financial year obviously impacts your bottom line and your profit. So it's important that you're aware, and also for cash flow purposes as well, to be looking at that and be aware of who is falling outside your payment terms. Stock is another thing that not a lot of business owners pay enough attention to, we don't see. Yeah. There are some simplified trading stock rules that you can apply. So You don't necessarily have to account for any change in your stock or movements in your stock if it's less than $5,000 and you're a small business entity. So if the variance over the year is less than $5,000, it's not necessarily going to impact your bottom line and impact your tax. But if you're carrying any obsolete stock or stock that you know you're never going to be able to sell, which in today's market we see that a lot, everything's changing so quickly, it is time to look at maybe writing that off, because when you're declaring your closing stock and your profit and loss, that's increasing your bottom line and increasing your tax. So it's something that we need to look at. Stock also affects your gross profit margins, and that's something we like to look at with our clients at this time of year as well, because if there's a big variance in those gross profit margins, and especially with the way that materials and everything's priced currently, it's something you really need to be looking at probably on a monthly basis if you're holding stock, and just be aware of how much things are costing you, what gross profit margins you're actually making, and so that you can put strategies in to make sure that you're actually recovering those changes. Prepaid income. That's something that potentially you have received a deposit on a job, or you've received a part payment on an invoice, but you're not actually going to do the work until the following year. It's important to have a look at that and record that, because that really should sit on your balance sheet. It's unearned income. You haven't earned that yet, and we can talk to our clients about how we can move that and pay tax on that effectively in the year that they're doing the work, which would be the following year. Obviously, timing of invoicing is very important. So looking at deferring invoicing, if you know that you see that this year's quite heavy on your invoicing, you know that there's going to be a downturn next year, you can defer invoicing, and that's a way to move income through to the following financial year. The other thing that some people aren't aware of is if you're selling a capital gains tax asset, so an asset that's going to attract capital gains, it's not the year that you actually receive the money that that gain becomes assessable. It's the date you sign the contract. So they call that the exchange. So the date you sign that contract is the date you have to declare that gain. So it's very important to plan around that type of thing as to what year you want that gain to sit in when you're selling a capital gains tax asset. And the other thing that we also talk about at this time of year with our clients, if they have had a capital gain, is to how we can reduce that, because there's lots of small business capital gains tax concessions, and you need to be aware of those, because there's some timing differences that impact whether or not you get access to them. And the other thing is there's ways to reduce those that may include things like contributing to superannuation, for example. So if we can give you the advice on how to minimise the tax on any capital gains, that's something we've looked at this time of year. I think we're going to touch on this a bit later, but the other thing that I find comes out of a lot of my tax planning meetings at the moment, which Rick touched on earlier, is that we look at the structure. It's still in the right structure. It may have been the right structure for you historically. It may have been the right structure for you as a startup. But I had a meeting with a client just the other day who's in the construction industry, and we're looking at whether or not the trust that originally was working for him is now the best structure or still the best structure. And we're looking at a restructure into a company to gain the 25% tax rate and move income into a company rather than in his personal name. So that's another thing that we look at heavily with our clients, is reassessing that structure, and it's something you probably need to do annually.
Yeah, I'm going to touch on that later, because there are some rules around allowing to restructure and not initiate a capital gain. So, and I'll just add, because it don't come out over the weekend, but in terms of capital gains and selling assets, especially if you sell property, the proposed changes to stamp duty and putting in like a GST type land tax may make you hang off a little bit until the state budget, which is only on the 21st of June, so it's about a week away now. Yeah. Okay, deductions. If the expenses incurred for your business, it'll generally be tax deductible. Now, there are a few things around that. I mean, entertainment, we know is not allowed, and there's others which will be part business, part personal. So you just got to, yes, they are deductible, but to what extent is the question?
Maybe because they're a good one, you might have some private use on your cars.
Yes, yeah, for sure. Okay, so the big one that's been around and still around, even if you miss out this year, the instant asset write-off. So where people have been taking advantage of that is with motor vehicles and plant machinery. Now, the big problem at the moment is if you're buying a new vehicle, there's up to a 6-month wait. So you're probably not going to get that before the 30th of June, but second-hand vehicles still apply, and you could get that before the 30th of June. But the reason why it's there, because it is a massive write-off. So if you buy a vehicle for $50,000, that's $50,000 that comes off your profit for that particular year. So if you've got profit, then that's something to look at. But saying that, as I said, you may miss that this year if you haven't already taken advantage of it. But it does go through to 2023. Another reason why I put that there is because if you're unaware of it, you may still be depreciating those items where you could be actually claiming the instant asset write-off. And also applies to the pool of assets. That's something that we see other accountants not.
Yeah, they're not aware. But if you have a small business pool sitting on your balance sheet, which is a pool of assets, it should be written off. It's actually, if you're using the small business depreciation rules, it's not a choice whether you write that pool off or not, it's an instant write-off. So similar to if you buy a new motor vehicle, it's not a choice, it's instantly written off or expensed in the year. And if you've got a pool of assets sitting on your balance sheet, just have a look for that, because if you're running that pool on your balance sheet at year end, it should actually have been written off.
Yeah, and that's another deduction too.
Yeah.
Superannuation deduction. So if you've got cash flow and you've got some funds there, you can contribute up to $27,500. So that does include your SQC. So if you've paid yourself $100,000 in wages, and you've already paid $10,000 in super, there's another $17,500 you can pay before the end of the year. And what we're also saying there is pay it before the 30th of June 22 to get the advantage of it. Now, you can't leave it at the 29th or 30th because it's got to be in the superannuation fund.
Xero is saying the 14th of June is their expected cut-off date if you're processing, say, through Xero. So most softwares will be the same. The most clearinghouses will give you the same date.
Yeah.
If you're paying into your self-managed super fund, it's a bit different because it's a direct transfer and you can get the money in there quickly. But if you're paying into an industry fund, just be really careful of those clearinghouse dates, because they do report back to the tax office. And and we found a few people who thought that they'd got in on time, but they actually haven't.
No. And so, similarly, if you've got employees, you're looking for deductions. Normally, you wouldn't pay that until the 28th
of July.
28th of July. But if you bring it forward and pay it now, superannuation for those employees, we'll be able to get the deduction in 2022. On a personal note, also another thing which a lot of people don't know about, there is a catch-up rule in relation to superannuation. So if you haven't previously taken advantage of contributing up to $27,500, I believe it's 3 years, isn't it?
Yeah,
so you can do a catch-up. So if you've only put $10,000 in it last year, you've got $17,500 extra you can put in. So using my previous example, you're putting in 17.5. You could actually put another 17.5 in and still qualify. But speak to your advisor in relation to.
I think another really important thing around planning for your superannuation deductions as well is where you want to claim those superannuation deductions. We've had a few really effective tax strategies for our clients where they've paid themselves a dividend prior to the 30th of June out of their company. So they've got some franking credits in the company, they've paid themselves a dividend, and then they've contributed that money straight into their super fund and claimed the tax deduction in their personal tax return, which is now allowable, I think, the last 2-3 years. So it's often more tax effective to do that because they may be paying tax at the highest tax rate or a much higher rate than the 25 cents that the company is paying. So they'll get a better tax deduction and a better return on investment by doing it that way.
Yeah, no, we've utilised that a couple of times over the last year or so. Prepayments. So another way of trying to reduce the income in or your taxable income in 2022, you could prepay your rent. Insurance is always due. A lot of insurances are due around the 30th of June, so you could prepay that. You may have a loan. You could prepay the interest on that loan. Just talk to your bank. They'll quite often allow that. You might have advertising, sponsorship, subscriptions. All those things can be prepaid. Of course, accounting fees obviously can fall into that category as well. But yeah, you know what I mean. So think about what things I could things that I know I'm going to have to pay in 2023, bring them forward and pay them in June to get the tax deduction in 2022. Similarly, if you, the fourth one is purchase stock in advance. So what I'm saying there, and this applies really both accrual and cash. because if you know that, if you're using an electrician as a great example, you may have a lot of maturity, you may have jobs coming up, builders as well, and you know you're going to have to buy that stock in July, and you've got a profit in 2022 in your entity, then you can pre-order that stock. So that's another good way to try and reduce down your income in taxable income in 2022. Okay.
Okay, so some other
Yep.
areas that we look at as well. So I'll just touch on the top one, because I think the expenses being the instant asset write-off of the motor vehicle, if you have left it too late and you're unfortunately not going to get that vehicle this year, but you will get it in July or August, all isn't really lost, because we can make use of the loss carryback scheme, which basically lets you carry it. If you make a loss next year because of that write-off of that asset, we can carry it back and we can recoup tax that you paid in this year. We can recoup tax all the way back to the 2019 financial year. So it's a really good strategy to use. If you have got a loss, make sure you look at utilising that loss to claw back some tax that you paid previously. Yep.
R&D is another one, and I'll just briefly mention this. It's really a specialty area. It's not something that we calculate. There's advisors who do the R&D. But if and there are a number of manufacturing businesses around where you may be designing or producing an item that you've had to do a fair bit of research on, and there's wages and things going into that. There is quite a good incentive through R&D, but it's something that, as I said, it's a specialty, and you really need to speak to an R&D. But I know people in the past, manufacturers, I can think of one in particular, where they were building an item for Woolworths, it was, and they really had to design it from the start. So that was an R&D claim, and we've had a couple of others along those lines as well.
If you're unsure about that, just ask the question, and we can always refer you on to some tax advisors that can tell you initially whether or not you would even qualify it, but then they can take it forward to actually make the claim for you as well.
Yeah. Once again, this last one, small business concessions, it's not going to apply to a lot of people, the professional expenses for startups. So if you're a startup, you are allowed to claim expenses which normally for instance, formation expenses, things like that, that you would normally have to carry forward and even on your balance sheet as an incentive to startups. You're allowed to write them off in that particular year. And the other one we're talking about is the small business restructure rollover. So if you take advice and as Bryn was saying previously, maybe a sole trader, but it's now a better option for you to be a company or a trust. You can do that without triggering capital gains if you fall into the small business category, which a lot will. And they've got this, once again, another incentive, small business restructure, rollover, and you're allowed to do that without triggering that capital gain. So if you've got, you're not selling your business or your equipment, it's just rolled into a new entity. Okay. I think that covers most things, but open to questions. So Chantel, we're over to you if there's any questions.
Yeah, just having a look now. There's no questions at the moment, but if you do have any questions, please send them through. We're happy to answer them after the webinar as well.
Yeah, we're happy to email those through or give you a call.
Yeah. Okay, great. Hopefully that was helpful to you, and you can take advantage of some of those before the 3rd of June. But as Chantel said, just forward any questions, and we're happy to answer them for you. Thank you for joining us.
Thanks, everyone.
See you later. Bye.
Bye.